Hello, welcome back to the Compassionate Capitalist Show. I'm Karen Rands, and occasionally I will go ahead and do a podcast or a video cast with just myself as my guest because there's a topic that's timely, something that keeps coming up, or something I need to explain further. And so today we're doing that. So, one of the things that I offer to investors that are new, have purchased my book, or are solo investors out there that, or even angel investor groups or small groups that simply don't have the time and the resources to do initial evaluations. And they say, well, Karen, how do you have such a great track record of identifying these red flags that can predict the success or the failure of a company? Now, granted, there are a lot of situations that will cause a company to fail even after they have received an initial round of capital or have been cleared by a screening committee. And these are sometimes are factors outside of their control. They unanticipated changes in the marketplace or trends, regulatory changes, and even like what we experienced recently with COVID. There's cash flow remedies that can help to prepare and anticipate of those kind of changes that, but those are real that oftentimes entrepreneurs don't um, understand or embrace, and the investors are passive, so they're not always looking at those characteristics on a day-to-day, month-to-month basis. But there are some ways that you can identify that based on an initial conversation with the entrepreneur, or just looking at other characteristics of how they do things. And so we started back when I was running the angel investor group, the network of business angels and investors, implementing a process and a policy that would screen a company and give them a red light, yellow light, green light for going forward with our investors. And from that, we would produce usually about a 10-page report that the entrepreneur could then could use to see how they would be more investor ready, but also investors could use it to see whether they wanted to go ahead and help that company move from yellow to green, or avoid the red. If there was something really compelling specific about it, then they might work with the company, provide the capital that the company need, the oversight, help pull the team together so that they could move from red to yellow to green. So in this talk today, I'm going to go over at a high level what are those categories, what are those areas that we look at, and why they're important. So you listening as an entrepreneur today could assess this for yourself if you're in the process of starting to raise capital, and also to the investor if you're looking at deals. You're welcome to come to us and save time and money, save the potential money that you might lose on a deal, and the time you might spend going through due diligence with a quick, uh, just a few days turnaround. You would have a report that would tell you if they're red light, yellow light, green light. So, uh, so what do we look for within that? Right. This is built off of a decade plus of working with entrepreneurs, seeing the ones that succeed, see the ones that raise capital, but also even more importantly, the hundreds of investors that I've interviewed when I was managing the network of business angels and investors, as well as when I was preparing to write my book, Inside Secrets to Angel Investing, which of course is the primer to learn would you, should you, could you be an investor in entrepreneurs. So the first thing that we do is we look at it, we assess their business plan, their pitch deck, their executive summary, and their financial forecast and their offering terms. And within that, we look at an overall, um, how do they explain their business? How do they organization oh, I'm sorry, how do they organize their information so that it's clear to understand and it tells a story, because this is an indicator of their ability to raise more capital or all the capital it needs. Because when you're first raising capital, you're going to do the initial people that already know you, that are subjective to what you're doing. They're connected to your product or your offering, or they're connected directly to the entrepreneur. And so they are emotionally attached to wanting to invest. So they may overlook some other things. And a lot of the red flags that we identify are from investors that made an emotional decision, which they all do. I've done it. Uh, and then, afterwards, they hindsight, when that deal went south or the deal didn't scale the way they thought it was going to scale, it got stuck in a plateau, a payroll exit, as Hal Martin would say. So they then and they go, I should have known that if I just asked this question, or if I just looked up this information, or I just did whatever, I would have known that this company didn't have the potential to achieve all their results. And or would have had a better insight, or done something in the way that they structured their offering so that it would mitigate that risk. So overall, we look at how they structure and organize their information. And one of the things that we look at, because a part of it is really an entrepreneur understanding their marketplace. And so this is one of our little things. If the thing that makes them really compelling, the thing that's like, oh, there's the hook, if it's halfway through the plan and it's not at the beginning, we know that they don't understand how to talk to investors, and they don't know what investors are looking for and why investors care. And they're likely not going to raise all the capital that they want. That's just one of those early indicators. The next thing we look at is accuracy and currency. So are they referencing statistics that are very old? Are they consistent in explaining their financial model with what's in the financial model? Because if they lack accuracy and currency and consistency between their documents, that shows either a level of laziness, disorganization, or they could be don't know how to delegate properly, and then how to manage the team properly, because sometimes somebody might be doing a piece of the work for them. If they're completely outsourcing their business plan, this could very well be an issue, because something that somebody that went and researched something on their own and produced it to the giving it to the entrepreneur. The entrepreneur is sort of like, well, this is it. I don't really, I'm just taking my business plan because I just paid a bunch of money for it. But they don't actually get involved in the process to make sure that it's accurate for their industry or accurate in the information. And a lot of times we would find discrepancy in numbers and a discrepancy in like strategies and things like that they're going to use. The next category or element that we use in the research and the assessment is target market and positioning. We look at the content, provided to determine if that target market and the strategy to gain the market share is reasonable and attainable, relevant to the type of product, price point, and sales strategy and competition. That's a big sentence, but it really addresses whether they can penetrate the market and reach the target market based on their strategy. So a lot of times entrepreneurs have limited foresight. They know how they're going to launch. They're going to get started a lot of times, and they'll just throw, social media or Facebook advertising or something like that. They make a lot of assumptions about the viral adoption of their product and the marketplace, and they don't really have a clear path or strategy. And you can see that reflected in their financials, which we'll talk a little bit more about. But when it's go to market, in order, you have to look at the pattern of success of companies that have achieved the high success rate of massive market adoption, millions and millions in revenue, tens of 20s to hundreds of millions in revenue. What was it they did? And there's not a name brand product that we know today that grew their entire business with Facebook ads. That's just the reality of it. And so when a business model only has social media or digital advertising as part of their strategy, then we know they are not really understanding their marketplace and how they're going to scale. So that's, just one of those types of things. If they are, their target market is a broad range of men 18 to 40 years old. An 18-year-old is very different than a 40-year-old. If they do, so they have to truly understand what is it that who are they targeting? and how are they positioning themselves in the market to wedge into a marketplace, which leads into their unique selling proposition. Have they done the work to truly authentic, to identify their authentic customer? Who is it that needs that product more so that it's going to be, and what are they willing to pay for it? Is there a clear need being met in the market by that product? And will that target market be able to identify the USP, the unique selling proposition, amongst the noise of the competition? How are they going to differentiate in the marketplace? And that is really a critical aspect. A lot of times, this is the reason why people, a lot of these organizations will go to these business model canvas, because they're trying to get people to narrow down their target market and their unique value proposition and their authentic customer. Because most entrepreneurs, particularly startups, have a very broad scope of that, and they don't do the work needed to really understand how they're going to get to market. Now, they may be off and they have to pivot, or they've got to test and measure, but then they should explain that in their description, that this is what they're starting with and this is how it might change over time. Which leads into competition and barrier to entry, because when you're starting in a marketplace, first of all, in competition wise, there's never a situation that there is no competition. There is what the market perceives as the competition. And even if you're, whatever it is, they're solving that problem now in some form or fashion. So how are you going to educate them that you have a different way of solving that problem, so that they're going to be able to see it and want it and pay for it, right? And so there's the status quo can be a competition. They can just choose to keep doing things their own way. And then there's the big guys. If there's somebody that is a big player in the marketplace that you serve and they just don't have the niche product that you have, well, part of what your SWOT, if you use a SWOT, competitive analysis, that's strength, weaknesses, opportunities, threats. A threat may be that this company may go and develop a product, but it's also an opportunity that they may be willing to buy your company. They also might be a source of funding to help you develop the product if they've identified that need in their niche. But this also relates to how the scalability of a company. I've had investors that spend a lot of time working with an entrepreneur, working through understanding, getting ready to invest, and then elected not to, because they finally decided, once they got to know the customer and the target market better than the entrepreneur, that the entrepreneur was not going to be able to scale. And that's probably the biggest risk associated, because, with a company and being able to get the internal rate of return that the investor wants. So, and then what's the barrier to entry? Is there intellectual property? Are there relationships that, such as partnerships, joint venture partnerships, certain strengths that the entrepreneur or the team have that other people don't have related to that? So it's got to be, the barrier to entry has to be more than just money. It has to be something that's in the know-how of the entrepreneur or the team, and the relationships that they have, or access to markets that they have, and then also intellectual property that might create that barrier for somebody just to come in and spend more money than you and be able to take that market away, particularly if you've been creating a market because you were doing something novel and new. And then traction. Under traction, we look at what has the company done to validate their business model. That would be in the evidence of beta tests, customers, revenues. Without that, it's what joint venture partnerships they have, an MVP, a minimal viable product. They've got a prototype that they've done, that they've shown to people. They've, got a commitment for people that says, if it does this, I'll do that. I'll buy it if you when you get this. So, not just because you talk to somebody at a trade show. It has to be something in writing that shows that you've got traction. And this goes directly to the value of the company. Sometimes just because an entrepreneur wants a $10 million valuation when they're raising capital doesn't mean that they qualify for a $10 million valuation. There are third-party independent organizations that will evaluate the intellectual property and give you a value for that. You can look at there's where are you in the process? There's a difference between a patent filing, a patent pending, and a patent awarded. All of those drive a different level of traction in the marketplace and a different valuation when it comes to looking at what is the inherent value of the company before you've received capital. And so without those areas that also affect the barrier to entry, you're really at an idea stage, and you are going to get the minimum amount of capital, and most likely going to have to do it on some form of a debt instrument like a safe note or a convertible note, because it's too hard to assess what the capital is, what the valuation is. But the whole approach to doing this, and when you raise your capital and you put a capital strategy in place, is to understand that you gain value in the company through each round. So even though you're giving up majority of your share, or you're giving up a share of the company as the company further gets diluted, the amount of capital and the amount of equity that's giving up for the amount of capital continues to get smaller for the larger amount of capital as the company gains valuation. But you need to plan that from the get-go. And so when I'm evaluating for an investor, I look at the cap table and look how they've structured the cap table, and look at those kind of things. Look at the rest of their capital needs. What are they going to? Do they know how much they really are going to need, and when they're going to need it? Because one of the biggest flaws in a company and where they fail is because they fail to raise the right amount of money for the stages, and they underestimate how much time it's going to take to raise the next round of capital. And they lack the resources to effectively raise the capital because the way that their team is set up, or because they refuse to hire professionals to help them in that process. They're throwing mud on the walls, and they're not being very effective or efficient in their raising their capital. Management and advisory board. We look at the management to see what relevant experience they have. Is this just a bunch of people that got together because they had a good idea, or do they actually have relevant experience in the industry or in the product that they're trying to solve, or in the solution they're trying to bring to market? And if they don't have that management because they don't have a lot of money, then who do they have on their advisory board that has experience in that will open up the door? And those people may become employees once they get funding. Right. So that's if you've got a situation where a company says, oh, I've got this great person that's going to come on and they're going to cost $300,000 and they're going to make or break us, we're going to be able to succeed because of them. Well, that person wants to come on board, then they need to be an advisor, and they need to open up their Rolodex for funding. Because if they're going to make that much of a difference in the company, they should be willing, one, to put their own money in, at least a little bit, to hire somebody professional to go raise capital, and two, open up their Rolodex and tell people that they're going to join this company when they receive funding. And if you give us funding, then I can start to be successful in this company and make you money, Mr. Investor, right? And then, so that's, those are real key. And then identifying, if they don't have those people, who will they need? Because that might be an exec with a check that'll bring money in and put in it. So if they don't have a CFO identified, a CMO identified, an operation person, a person that knows manufacturing, whatever their business is, if they haven't identified at least the skill set that they want that person to have, then they're not prepared for capital. They're not prepared to actually scale. You want to be able to put money into a company that knows what they're going to do with it, and the path that they're going to take, the shortest path they can get to revenue, and start be able to pay their own bills, not out of investor capital. And then investor capital can start to be used for growth strategy. And lastly, we look at in the investment structure and the return on investment. So this goes into the financials. Financials are really a true sort of like spyglass, magnifying glass on the thinking of the company, because a lot of times they will just go into a multiple. They'll do a formula, and it will just grow their business. And they really don't understand where the revenues are going to come from. They don't understand their sales cycle. They don't understand their cost of goods. They don't understand the resources that they're going to need in order to generate the revenue that they're talking about. There's a lot of available sources for that information. The Small Business Development Center, there's a lot of information that you can gather to understand that the advisors can help with that, particularly if they're people that are in big companies or have seen the growth of a company, because you don't get companies that have 10, 20, 30, $100 million and have a resource number, a people cost that is flat from when they were startup or when they were $1 million company. All of those expenses grow, and the bigger, and you don't have a small number on advertising, you don't have a small number on these things. You'll see technology companies will have a big R&D number and no, the tech founders, and they'll have none of this other number that can sustain that growth or support the growth that they intend. And that's a red flag. That means they don't know what they don't know, and they're not willing to go figure it out or get advice from somebody, which is the last and final thing is the coachability of that founder or that team of founders. Are they willing to listen and identify how they are going to go from a founder to a scalable company, what resources they need, what their plan is for doing that, the roadmap to do that, and the funding that they need to do that, the people, the money, and the plan. Do they have that? And so that is our red flag, business plan assessment, business assessment service that we offer. And we do, different flavors of it, depending on if an entrepreneur comes to us or an investor comes to us. There's additional things that we fold into the investor model on this, but, having run an angel investor group, done this type of evaluation on hundreds of companies. Now I serve as a mentor on business plans, companies that are competing. I've got track record where every company I've coached in the last 3 years has placed first or second in their business plan competition because I understand this stuff. And so I'm revealing, I'm kind of opening up the curtain for you guys to understand it too, because the purpose of the Compassionate Capitalist Show is to equip our entrepreneurs and our investors and the CEOs and the strategic advisors that listen to this podcast on what are sort of the key inside secrets to what helps a company succeed and produce the return on investment that founder wants for all his hard work or her hard work in building this company up, the wealth and the generational wealth they can create from a successful company, and for all those investors that are putting their money in some cases their time and knowledge in resources into these companies for them to succeed. They're doing it as a fraction of what the founder is doing, but they want to participate in that success without all the risk. But money is money, right? And time is money. So we work to save investors time and money, and entrepreneurs time and money in seeking capital, and investors in deciding which deals they want to spend time with to get through all their due diligence process. So thank you. Please go to KarenRands.co and get more information about the services that we offer to entrepreneurs and to the investors and that are going through this. And I look forward to talking to you. You can sign up for the Compassionate Capitalist Coffee Breaks, which are tips that I do, 1 to 2 minute videos that we send out on a week or bi-weekly basis. Just depends on the topic, every other week. Short little mental break for you to get a refresher in something that you need to be doing to work on your business. And with that, thank you very much for subscribing to the Compassionate Capitalist Show and to my channels, Onwards and Upwards.